Welcome back to the series that aims to give you, the investor, the key lessons to learn from hundreds of years of global market history. So far we've discussed the need to be realistic, to stay calm, and to forget trying to time the market. The next lesson is to keep it simple. The rules of sensible investing are actually relatively straightforward, but many in the investment industry appear to prefer complexity. Twice in recent years, that complexity has sent markets tumbling.
Wall Street recovers after another wild day, but London's stock market does it again, down another 250 points.
One of the things that happened in the 87 crash was that a lot of institutions were trying to do something called portfolio insurance, which was this idea that you could protect the value of your portfolio not going below a certain amount. And the way it was done was buying ordinary equities and hedging with futures contracts. And what happened in the crash of 87 was it didn't work because the futures fell out of bed at the same time as equities, and they weren't able to be quick enough to hedge their equity position. And one of the lessons that you learn from that is that complicated products often don't work the way you think they're going to work. Don't leverage up. Watch people who are hiding risk in ways that you don't understand. Stick to the plain vanilla products and you know approximately what their risk-return ratio is.
But of course, the lessons of market history often go unlearned, and just 20 years later came another crash, largely caused by investments that were so complex that not even the professionals understood them.
And what happened, it created a lot of debt and the banks became insolvent, and that's why the government's had to intervene and prop up these banks. If a bank or an investment bank cannot understand how toxic some of these investments are and how complex they are, your average man on the street, your individual investor that is sold these funds, well, how is he or she supposed to understand?
Yet still there are some who just don't get it. Even after what happened in 1987 and again in the credit crunch, the industry continues to peddle complex investments and investors continue to buy them.
I would caution against structured debt products. You know, we think, well, if I gather up a pool of assets, and of course the poster child for this was the CDO, the collateralized debt obligation, where I could gather up a pool of subprime mortgages and I could just slice it and dice it and package it in a way and I could create a AAA rated security out of that. I would be very, very skeptical about the notion that somehow with enough engineering we could generate bonds that pay more than what the risk might suggest.
So what's the answer? For a start, stick to what you understand. If you want to invest in shares, invest in shares. The same with bonds and cash. Products which combine different assets should generally be avoided. Of course, there are so many different types of equities you can buy. There are growth shares and shares for dividend income. There are shares from different sectors of the economy and different parts of the world. The simplest way of investing in equities is to invest in the entire market, a strategy known as passive investing.
Passive fund managing is basically a computer program. Generally speaking, they track an index, so it could be the FTSE 100 or the FTSE All Share, or it could be the DAX or the Dow Jones, something like that. And essentially this computer program puts a small amount of your money into every single company in that index.
But simplicity is just one of the advantages of the passive approach. It also provides greater diversification, but the biggest benefit is that it's far cheaper in the long run than paying an active fund manager to buy and sell shares on your behalf.
Gross return in the financial markets minus the cost of playing the game is the net return all investors divide up. So it's as simple as the relentless rules of humble arithmetic.
But you might say, surely an active manager can achieve better returns which justify the extra cost. Well, of course, in theory they can, but all the evidence suggests that generally they don't.
Well, the best study I know of was one carried out in the States over 35 years from 1970 to 2005. That looked at 355 funds. Just 9 of those funds beat the index by 2% or more, and just 3 of them showed sustained outperformance. Now, a study in the UK of 1,200 funds over 3 years, finishing in March of 2011, showed that just 1.3% of those funds were in the top quartile quartile for all 3 successive years.
If you're new to the idea of passive investing, you'll find plenty of information about it on the Sensible Investing website and on our YouTube channel. See you in part 6 for the next key lesson to learn from market history.